Hey everyone, and welcome back to the Deep Dive, the show where we take a big stack of research and boil it all down to the really good stuff, the stuff you can actually use. Today we're going deep on, well, a total classic, Benjamin Graham's The Intelligent Investor. Now, this book, it was first published way back in 1949, but get this, it's been updated over the years, and it's still considered like the Bible for a lot of investors, which I think really proves that its principles, they stand the test of time. Even Warren Buffett, right?
Yeah.
He credits this very book with his success. And he says it's not just for Wall Street, the big wigs,
Sure, yeah.
but for anyone who wants to build wealth, but build it the smart way.
Yeah, and one of the things that makes this book so powerful is that, it lays out a clear philosophy for investing. And it starts with a fundamental distinction between an investor and a speculator.
Yeah, Graham really draws a line in the sand there, doesn't he? So break it down for us. What's the difference?
Okay, so an investor, this is someone who looks at a business, analyzes its intrinsic value, and then buys a stake in it, based on that value. They're thinking long term, not about quick profits, but about that steady growth. A speculator, on the other hand, well, they're more concerned with those short-term price movements. They're trying to, ride those waves of market sentiment, hoping to buy low and sell high and do it quickly.
So it's like planting a tree and watching it grow into a big oak tree versus betting on which way the wind will blow its leaves.
Yeah, exactly. And Graham's point is that while speculation, sure, it might make you some quick money in the short term, but it's inherently risky and unsustainable, really. He uses the example of those meme stocks, remember a couple of years ago?
Oh, yeah.
Riot, Blockchain, Sundial Growers, as well.
Oh, man, yeah.
They skyrocketed, right? Pure hype, and then crashed hard, leaving a lot of people,
holding the bag. Ouch. Yeah, those are some wild times. So Graham's saying, instead of trying to time the market or chase the latest, fads, an intelligent investor, they focus on the underlying value of the businesses they invest in.
Right, and that leads us to one of Graham's, most famous concepts, Mr. Market.
Ooh, Mr. Market. This guy sounds like a real character. Tell us more.
He is. Okay, so imagine you have this business partner, Mr. Market, and he comes to you every single day offering to buy or sell your share of the business. The catch is, Mr. Market, he's, incredibly moody. Some days he's euphoric, offering you a sky-high price. Other days he's depressed, practically begging you to sell for pennies.
It's like having a manic depressive neighbor who keeps offering to buy your house.
Yeah.
Some days it's a king's ransom. Other days it's practically a steal. Would you take him seriously every time?
Exactly. Graham's point is that Mr. Market, he represents, the stock market itself, which it's often driven by emotions and irrationality rather than the actual value of the underlying businesses. The intelligent investor, they don't let Mr. Market's mood swings dictate their decisions.
Okay, so then how do we deal with this Mr. Market? How do we avoid getting caught up in his crazy roller coaster of emotions?
That's where Graham's concept of margin of safety comes in. Think of it like this. You wouldn't drive a 10-ton truck over a bridge designed to hold, exactly 10 tons, right?
No way. You need that extra buffer, that margin of safety, just in case.
Exactly. So when investing, your margin of safety, that's the difference between the price you pay for a stock and its intrinsic value. The wider that margin, the lower your risk. Graham argues that buying with a margin of safety, it helps protect you from Mr. Market's, those manic swings, and also from your own miscalculations.
Okay. So I'm starting to see how this all ties together. You use Mr. Market's mood swings, to your advantage. You're buying when he's feeling down, selling when he's overly optimistic. But you always make sure you have that margin of safety to protect you from potential losses.
That's it. And to illustrate this, you know how important this is. Graham uses the example of Amazon.com back in 1999. Remember, this was during the dot-com bubble.
Oh, yeah. Everyone thought they were going to be millionaires overnight.
Right. So Amazon's stock price, it was soaring. But the company, they weren't actually making much money. They had almost no earnings to justify that sky-high price. There was no margin of safety. And in contrast, Graham pointed to Walmart, a company with, a solid track record of earnings and a much more reasonable valuation at the time.
So even though Amazon eventually, obviously, became a huge success, if you had bought it during that bubble without that margin of safety, you could have been wiped out if the bubble had burst before it had a chance to really take off.
Precisely. The margin of safety is about protecting yourself from the unknown, from the inherent, uncertainties of the market.
That's some insightful stuff. But how do you actually calculate this margin of safety? And how do you know how much of a buffer you really need? Don't you need to be like some kind of financial wizard to figure that out?
Not necessarily. Graham offers several methods for determining, intrinsic value. And while they do involve looking at financial statements and understanding a company's business for sure, he presents them in a way that anyone can grasp.
Okay, so it's not just for the Wall Street gurus. Anyone can learn to do this.
Absolutely. And once you have a grasp of intrinsic value, determining the margin of safety becomes much easier. It's all about finding that sweet spot, between price and value.
This is making me think about, diversifying my investments, spreading things out a bit, right? Does that tie into all of this?
You bet it does. Diversification. According to Graham, it's like an insurance policy. For your portfolio, it's not just about spreading your bets across different companies, but also about protecting yourself, well, from your own mistakes.
Well, that makes sense. Because even if you do your homework and pick companies with a good margin of safety, you could still make a mistake, right?
Exactly. Nobody's perfect. And the market, full of surprises. Diversification helps to, cushion the blow if one of your investments doesn't pan out the way you expected.
Okay, so we've got margin of safety, we've got diversification. What other gems did Graham have in store for us?
Well, he had some interesting and perhaps even counterintuitive thoughts on where to find undervalued companies. He suggests looking at unpopular large companies.
Unpopular. What does he mean by that?
He's talking about companies that have, fallen out of favor with the market. Maybe they've had some temporary setbacks or the industry is going through a rough patch.
So it's like being a contrarian investor, going against the crowd. But isn't that risky?
It can be, but it's also where you can find some real bargains. Remember, Mr. Market, he's driven by emotions. When fear takes over, even solid companies, they can get, well, unfairly punished, creating opportunities for the intelligent investor.
It reminds me of that, buy low, sell high mantra, but applied in a more like strategic way, right? You're not just buying because the price is low. You're buying because the price is low relative to the company's, actual worth.
Exactly. And Graham suggests that these unpopular large companies often have a built-in margin of safety, just because the market is undervaluing them. It's like finding a hidden treasure that everyone else has overlooked.
Okay, so far we've talked about avoiding speculation, understanding Mr. Market, seeking that margin of safety, and diversifying our investments. This is a lot to digest, but it's incredibly insightful. I'm already starting to feel like a more intelligent investor, I think. What else is important to keep in mind on this journey?
Well, Graham has some strong warnings about certain types of investments that he considers, well, inherently speculative and potentially dangerous. We already touched on his skepticism of, new and hot investments. But he also cautions against excessive trading, relying too heavily on, market forecasts, and using margin or borrowed money to invest.
Yeah, those all sound like recipes for disaster, especially for someone who's, just starting out.
Exactly. He emphasizes that successful investing is not about chasing, quick profits or trying to outsmart the market. It's about patience, discipline, and a deep understanding of business fundamentals.
He really drives home the point that the stock market is not a casino, right? It's not about gambling. It's about making, well, informed decisions based on sound principles.
Precisely. And one of those principles is understanding the psychological aspects of investing. Graham dedicates a significant portion of the book to the role of emotions and how they can lead us astray.
Yeah, I think we can all relate to that. It's so easy to get caught up in the fear and the greed of the market. So how do we avoid letting our emotions cloud our judgment?
Well, Graham encourages investors to develop what he calls a rational temperament. This means resisting the urge to follow the crowd, staying focused on our long-term goals, and not letting our emotions, well, dictate our investment decisions.
So it's about being level-headed, not panicking when the market, takes a dip, and not getting overly excited when things are going well. Easier said than done, right?
It definitely takes practice. Graham emphasizes the importance of, self-awareness, recognizing our own biases and limitations, and developing strategies for managing our emotional responses to those market fluctuations.
I think this is one of the most valuable lessons in the book, that investing is not just about numbers. It's about understanding ourselves and how our emotions can impact our decisions.
I agree. And this leads us to another important aspect of investing, the role of investment advisors. Many people turn to professionals for guidance, but Graham, he cautions against blindly following their advice.
So even if we're working with an advisor, we still need to be, well, informed and engaged, not just handing over our money and hoping for the best.
Exactly. He encourages investors to understand, the fees they are paying, the incentives their advisors may have, and the potential conflicts of interest that can arise.
It's about being an informed consumer. Even when it comes to, investment advice, we need to ask tough questions, understand our advisor's investment philosophy, and make sure their interests are aligned with ours. Now, one thing that really caught my attention was Graham's discussion of, shareholder rights and the relationship between shareholders and management. He seems to believe that shareholders have a bigger role to play than just passively collecting dividends.
Absolutely. He argues that shareholders should take an active role in overseeing the companies they own. They should demand transparency and accountability from management and advocate for policies that benefit long-term shareholders.
So it's about being an engaged owner, not just a silent partner.
Precisely. He believed that an informed and an engaged shareholder base, well, they can help ensure that companies are run ethically and efficiently for the benefit of all stakeholders.
Now, throughout the book, Graham provides, numerous examples and case studies to illustrate his points. One that really stood out to me was his analysis of NVF Company. Can you tell us a bit more about that?
Yes. NVF, it's a fascinating case study. It's a real-life example of how quickly a seemingly promising company can unravel, particularly when driven by, excessive debt and aggressive acquisitions.
What happened?
So the company, they went on this buying spree, racking up massive debt. But then things went south, their earnings plummeted, their stock price crashed, and they eventually ended up in, financial distress.
Wow. That sounds like a cautionary tale about the dangers of getting caught up in the hype.
Right.
And ignoring the fundamentals.
Exactly. And Graham uses NVF to illustrate, several important points, including the dangers of overpaying for acquisitions, the importance of scrutinizing a company's accounting practices, and the need for that margin of safety.
It's a reminder that even experienced investors, right, they can make mistakes.
Yeah.
Especially when they let, greed and overconfidence cloud their judgment.
Absolutely. And it underscores the importance of sticking to those, core principles that we've been talking about. Margin of safety, intrinsic value, and discipline.
Okay, we've covered a lot of ground here. We've talked about building a portfolio, both for, defensive and enterprising investors. We've discussed the pitfalls to avoid, the importance of understanding our own emotions, and the role of investment advisors. But I have a feeling there's still more to unpack. What else did Graham have to say that's relevant to us today?
Oh, there's plenty more, yeah. But I think we'll have to save that for next time.
All right, well, stay tuned, everyone. We'll be right back with part 2 of our deep dive into Benjamin Graham's The Intelligent Investor. Don't go anywhere.
Oh.
Welcome back to the deep dive. Before the break, we talked about the core principles of, intelligent investing. But now we're going to get into, I guess you could say, the nitty-gritty of how to actually build a portfolio. Now, Graham, he outlines different approaches for what he calls defensive and enterprising investors. So for our listeners who are maybe, a bit more cautious, where do they even begin?
Well, defensive investor, they're looking for stability and security. They're not, looking to beat the market or anything. They want to protect their capital and grow it, but slowly and steadily.
Okay, so no risky bets on the,
Right.
the latest meme stocks. Got it. But what should they be investing in then?
Well, Graham, he suggests a balanced approach. He recommends allocating, between high-grade bonds and a diversified selection of high-grade common stocks.
So even a defensive investor shouldn't shy away from stocks completely.
That's right. Historically, stocks have outperformed bonds over the long term. But remember, we're talking about high-grade stocks here, companies with a proven track record of earnings and dividends.
Okay, that makes sense. So no gambling on unproven startups, just sticking with the, the tried and true blue chips. But how do you actually choose those companies? I mean, there are, thousands of stocks out there?
Well, Graham, he provides some specific criteria. He suggests looking at a company's financial strength, its earnings stability, and its dividend record. He even recommends focusing on, larger, well-established companies that have weathered various economic storms.
Wow.
So
looking for companies that have been around the block a few times, so to speak, ones that have, stood the test of time.
Precisely. For the defensive investor, it's about sticking with those companies that have demonstrated, resilience and consistent performance over time.
Okay, that makes sense.
Yeah.
At least for our, more conservative listeners. But what about those who are a bit more, well, adventurous? The enterprising investors. What advice does Graham have for them?
So the enterprising investor, they're willing to, put in a bit more work and take on a bit more risk for the potential of, higher returns. They are looking for those undervalued gems that Mr. Market has overlooked.
So it's all about finding those hidden treasures,
Yeah.
the diamonds in the rough. But how do you actually find them? That seems, I don't know, like a daunting task.
Well, Graham offers a few approaches. One is to look for companies that are, going through a period of unpopularity, maybe due to, temporary setbacks or negative sentiment, but whose underlying business, well, it remains strong.
So almost like taking advantage of Mr. Market's, bad
Right.
moods, buying when everyone else is selling.
Exactly. It's about being a contrarian investor, going against the crowd. He also suggests looking for companies that are, statistically cheap, meaning their stock price is low relative to their earnings, their assets, or dividends.
Okay, so we're talking about using, those financial ratios and metrics to identify like potential bargains. But doesn't that require a lot of, number crunching and financial expertise?
It does require some analysis for sure. But Graham, he lays out these concepts in a clear and accessible way. And remember, we're not talking about becoming,
They trust.
traders,
Yeah.
frantically buying and selling based on, every little price movement. We're talking about doing our homework, understanding the businesses we invest in, and having the patience to let our investments grow over time.
It's about being an informed investor, right? Not just following the herd or listening to the talking heads on TV. You really need to understand what you're buying and why.
Absolutely. And speaking of understanding what you're buying, Graham was a huge proponent of, digging deep into a company's financial statements. He believed that was the only way to truly determine its worth.
So no relying on those glossy brochures or fancy marketing pitches. You got to get down and dirty with the numbers.
That's right. He urges investors to look beyond the headlines and carefully examine things like, earnings quality, debt levels, management's track record, and accounting practices.
It's like being a detective, right? Piecing together the clues to uncover the true story behind those numbers.
Exactly. An intelligent investor, they need to understand how those numbers are generated and what they truly represent about a company's,
Financial health.
Now, I know Graham was also a fan of, well, he called them special situations, those unique circumstances that can create investment opportunities. What kind of situations did he have in mind? Well, he mentions things like, arbitrage opportunities, where you can profit from price discrepancies between different securities. He also talks about, workouts or liquidations, where you can potentially buy assets for less than their true worth.
That sounds, I don't know, a bit more complex. Is that something the average investor can really take advantage of?
Those strategies, they can be more, more involved and require a deeper understanding of, financial markets. But Graham, he believed they could offer significant potential for profit, particularly for, the enterprising investor who is willing to put in the extra effort.
So for our listeners who are, maybe up for a challenge and have a bit more experience under their belts, these special situations might be worth exploring. But for those who are just, starting out, it's probably best to stick with the basics.
That's a good point. It's important to start with what you're, comfortable with and gradually expand your knowledge and experience. Graham emphasizes that there's no one-size-fits-all approach to investing.
Okay, so we've talked about what to invest in, both for, defensive and enterprising investors. But there's also the flip side of that coin, right? What about things to avoid? Those red flags that should make us, I don't know, run for the hills.
Absolutely. Graham issues some, pretty strong warnings about certain types of investments and strategies that he considers, well, inherently speculative and potentially dangerous. We've already touched on his skepticism of, new and hot investments. But he also cautions against, excessive trading, relying too heavily on, market forecasts, and using margin or borrowed money to invest.
Right. Those all sound like, I don't know, recipes for disaster, especially for someone who's, just starting out.
Exactly. He emphasizes that successful investing, it's not about, chasing quick profits or trying to outsmart the market. It's about patience, discipline, and a deep understanding of business fundamentals.
He really drives home the point that the stock market is not a casino, right? It's not about gambling. It's about making, well, informed decisions based on, sound principles.
Precisely. And one of those principles is understanding the psychological aspects of investing. Graham dedicates a significant portion of the book to the role of emotions and how they can lead us astray.
Yeah, I think we can all relate to that. It's so easy to get caught up in the fear and the greed
Yeah.
of the market. So how do we avoid letting our emotions, cloud our judgment?
Well, Graham, he encourages investors to develop what he calls a rational temperament. This means, resisting the urge to
Follow a crowd.
staying focused on our, long-term goals and not letting our emotions, dictate our investment decisions.
It's about being, level-headed, not panicking when the market takes a dip and not getting, overly excited when things are going well. Easier said than done.
Yeah.
It definitely takes practice. Graham emphasizes the importance of, self-awareness, recognizing our own, biases and limitations,
Right.
and developing strategies for managing our emotional responses to those market fluctuations.
I think this is one of the most valuable lessons in the book.
Yeah.
That investing is not just about, numbers. It's about understanding ourselves and how our emotions can impact our decisions.
I agree. And this leads us to another, important aspect of investing, the role of investment advisors. Many people, they turn to professionals for guidance. But Graham, he cautions against, blindly following their advice.
So even if we're, working with an advisor, we still need to be, informed and engaged, not just handing over our money and hoping for the best.
Exactly. He encourages investors to understand, the fees they are paying, the incentives their advisors may have, and the potential, conflicts of interest that can arise.
It's about being an informed consumer. Even when it comes to, investment advice, we need to ask tough questions, understand our advisors, investment philosophy, and make sure their interests are aligned with ours. Okay, so we've been unpacking Benjamin Graham's The Intelligent Investor, a book it's packed with wisdom, and it's as relevant today as it was, decades ago. We've covered a lot of ground, but there's one area I'm really curious about. What did Graham have to say about investment funds and, those Wall Street pros who claim to have all the answers?
That's a great question, and it's one where Graham really challenges, the conventional wisdom, I guess you could say. He was skeptical of the idea that professional money managers could consistently beat the market.
Wait, you mean those high-priced experts with all their, fancy algorithms and market insights might not be the secret to riches?
Well, Graham, he looked at the data, and he found that many mutual funds, they actually underperform the market over the long term, especially after you factor in, their fees.
So paying someone a hefty fee to manage your money might not actually get you better results than simply investing in a low-cost index fund.
Yeah.
That's a pretty radical concept, especially, back then.
It was, and it still is in many ways. He argued that the pressure to outperform, it often leads fund managers to take on more risk and engage in, excessive trading.
Which can, it can eat into returns.
So it's not just about, picking the right stocks. It's about having the discipline to stick to a strategy and avoid those costly mistakes that can, sabotage your returns.
Exactly. And this goes back to Graham's core principle of being an intelligent investor, right? Not just blindly following the herd or chasing the hot fund manager of the moment.
Okay, so what's the takeaway here? For our listeners who are trying to navigate this complex world of investing, well, Graham, he wouldn't completely dismiss the role of, professional managers, but he urges investors to be discerning, understand the fees, the fund's track record, and its investment philosophy before entrusting your hard-earned money to anyone.
It's like being an informed consumer,
No,
doing your research.
before making a purchase.
Right.
Don't just go with the flashiest ad or the biggest name.
Right. And Graham even hints at the idea that for many investors, a simple low-cost index fund might be a more sensible option than trying to, pick individual stocks or chase those elusive market-beating returns.
Now, that's something I bet a lot of financial advisors wouldn't want you to know.
Perhaps. But Graham, he was all about, empowering the individual investor, giving them the tools and the knowledge to make their own informed decisions.
I love that about this book. It's not just about, formulas or stock picks. It's about developing a mindset, a philosophy, really, for approaching investing in a way that makes sense for you.
Absolutely. And I think one of the most powerful takeaways from The Intelligent Investor is the idea that, well, that your biggest challenge and even your worst enemy in the market is likely to be, well, yourself.
Ooh, that's deep.
Mm.
So it's not just about, outsmarting Wall Street or predicting the next market crash. It's about conquering our own, internal demons. Tell me more.
Well, Graham recognized that,
Mm.
our emotions, they can lead us to make, well, irrational decisions. Fear can make us sell at the bottom of a, market crash, and
Right.
greed can make us chase those hot stocks that are already overpriced.
Now, it's not just about being, smart with numbers. It's about being smart with our own,
Apology.
our own like behavioral pattern.
Exactly. Graham, he emphasizes the importance of developing a rational temperament, learning to control our emotions, and sticking to a disciplined investment strategy, even when, things get a little turbulent.
Easier said than done.
Right.
Especially when you see your, portfolio taking a hit.
Yeah.
Or everyone around you is making a killing in the latest craze.
It takes practice,
Yeah.
but it's essential for, for long-term success. It's about, taking a step back, remembering your long-term goals,
Yeah.
and not letting those short-term fluctuations shake your confidence.
This has been an incredible journey, really, through The Intelligent Investor. We've covered so much ground. There's one final quote from Graham
Yeah.
that I think perfectly sums it all up. He says, "The investor's chief problem, and even his worst enemy, is likely to be himself." It's a reminder that our own emotions, our biases, our impulses, they can often be our biggest obstacles to investment success.
He's absolutely right. It's not just about, outsmarting Wall Street or predicting the next market crash. It's about conquering our own internal demons,
Mhm.
developing that,
Mhm.
that rational temperament, learning to control our emotions, and sticking to a disciplined investment strategy, even when, things get turbulent. By doing so, we can transform ourselves from our own worst enemy into our own best friend
Yeah.
on the path to financial success.
This deep dive has been, well, truly enlightening. Benjamin Graham's The Intelligent Investor. It's a timeless classic that offers, well, a wealth of wisdom and practical advice for anyone who, wants to build wealth, but build it the smart way. We highly recommend it to anyone who's, serious about becoming an intelligent investor. And remember, investing is a journey, not a destination. And the key to success is to keep learning, stay disciplined, and never stop striving to become a more intelligent investor.
And if you'd like to continue the conversation, be sure to join us on, our social media channels, where we'll be sharing additional resources and insights related to Graham's principles. Until next time, happy investing.
And remember, you have the option to be an intelligent investor. You do not have an obligation. Thanks for joining us.
Did you get any of that?